Welcome to Financial Strategies with Andrew and Daniel Adjemi, powered by the Retirement Income Store and brought to you by Adjemi Financial Strategies in Guilford, Connecticut and Denver, Colorado.
Daniel, I read recently how only 27% of workers are confident that they're going to be able to have a comfortable retirement. Isn't that an egregious thing?
It's crazy. And I keep talking to investors and people who are serious about the retirements, and they're worried about inflation. They're worried about these prices going up and up and up. And if you're living comfortably on $50,000 a year right now, with just a 3% inflation rate, you would need $121,000 to maintain the lifestyle you have right now in 30 years.
That's crazy. That is, what can we do to be able to increase the percentage of people that be able to have confidence that they're going to have a retirement, a comfortable retirement, and be able to stay ahead of inflation and such? I think we should talk about that on today's show. I'm Andrew Adjemi.
And I'm Daniel Adjemi, and you're listening to Financial Strategies. Today, we're talking about opening the doors of possibility.
Yes, exactly. And we want to be able to speak to those that don't know what they don't know, right? There's a lot of information out there, a lot of talking heads, but just because there's information out there, we need to make sure that we have that information that's going to be pertinent to people's lives. So, when we're talking about the possibilities, we're talking about possibilities of staying ahead of inflation. We're talking about possibilities that their investments are going to be in a place that are going to be able to help them last the rest of their life, and not some cookie cutter investment program, right?
Right. It's the way that the Federal Reserve has pushed investors out on the risk scale is crazy, right? Because if you leave your money in CDs or you leave it in the traditional ways of generating income or safer things that retirees have been historically used to, right? You put your money in the US Treasury, make 6%, and $60,000 a year off your $1 million, no risk in a US Treasury. That was pretty simple, right? That was a pretty simple way to have a comfortable retirement. But now, last month's inflation numbers came in at 3.5%. So if you have money in the bank and you're earning a whopping 1%, and that you'd be lucky to get 1% at the bank right now, that's actually, you're losing 4.3% of purchasing power. And so no wonder only 27% of people considering retirement are confident that they're going to be able to maintain that lifestyle over retirement.
Yeah. And rightly so with, these things happening. I mean, inflation coming into play, and we're paying, at least in Connecticut, 70-80% more for a gallon of gas than we were in January, and not to mention food prices going up, that kind of thing. But there are ways to be able to stay up with this. And that's where, the traditional investment organizations and so forth that are so stock market oriented kind of fall down, wouldn't you say? I mean, people think the stock market is going up, but is it really?
Well, I guess it would depend what you measure that, and I think that's a little complicated to talk about on today's show. But what people do know, right, is they look at things like housing, utilities, especially if you're in places like California or Florida. Utilities have gone through the roof. Taxes, right? These are all things that have gone up and are continuing to go up tremendously. Transportation, you look at airline tickets, food, right? Medical expenses, insurance, entertainment, vacations. These are things that have gone up over the last year and the last decade tremendously.
Yeah.
So how do you protect yourself from that in retirement if you're not going and getting a job? People, there's this debate about the transitory inflation, like it's going to stop. But
Yeah.
you drive around and everyone's looking for workers and they're offering $18 an hour for a starting job.
Right.
Well, how is that transitory? They're going to in a year say, actually, we're going to lower your pay back down.
Nope. The government won't allow that. You can't bring people's pay down. You can only go up with it. So so then what does that mean? That's the whole cycle. I remember my parents teach me about that when I was 10, 12 years old. When prices go up, when pays go up, well, then prices got to go up to compensate for that. And it just causes this inflation thing. And so I agree. I don't think it's transitory. I think inflation is here. The question is to what extent, how bad, how long, those kinds of things.
Yeah. And then you go to the fact where, a company like Coinbase, they offer a lend or a yield program where you can earn 4% on your dollars. And that sounds nice. But then the SEC comes in and says you can't do that. So the SEC's telling people, we don't want you. We want you to stay poor. We don't want you, or we want you to go out on the risk curve, right?
Right.
We don't want you to earn 4%. So we're going to stop this company from offering 4% to protect investors. How is by making you go from 4% to nothing protecting any investor? It's protecting Wall Street.
Right. And the government, is about control. The government's trying to keep, as many people as they can under control. Same thing with Wall Street. They want as much of your money in the market for as long as they can because they make money when the market goes up. They make it when it goes down. They make it when it goes sideways. But if you've got your money in the stock market, it only is making money if it goes up. So that's that. But there are possibilities. There are options. There are opportunities out there to be able to do things differently. But you have to open your mind to that. And, one of the things that might be very important for us to be able to give to people who listen in today, Daniel, is, the essentials of what you need to know about retirement income. The white paper, the brochure that we have put together for people to educate them on the right and wrong ways to invest for income, because people don't understand income. They think withdrawals are income, but that's not necessarily, that's usually not the case. That's a withdrawal method, not an income method. So, I think if you and our listening audience, if you just joined us, you're listening to Financial Strategies with Andrew and Daniel Adjemi, and it's about the strategies that you invest with more than the investments themselves. And, we have this piece that we'd like to give you today, the essentials of what you need to know about retirement income. Just call it retirement income. Call up for Ask by Name. I want the piece on retirement income, right? 800-725-7616. We'll be glad to get that off to you as soon as we can, right? 800-725-7616. Daniel, opportunities, right? Opening doors of possibilities, opening doors to opportunities that are out there for people to stay ahead of inflation, to be able to invest differently than what the cookie cutter approaches are by most organizations out there. There's seems to be two ideas out there, generally speaking. One is, keep your money at, safe and in the bank where you're not losing principal, but you're losing purchasing power, or, risk it in the stock market where you're risking your principal, you're risking your purchasing power with that as well. But people don't think of that way because they tend to think of the potential, the possibility, which is a good thing, opportunity, possibilities, that's a good thing. But what about a little bit more, balanced approach?
Yeah, well, I like when you're talking about that white paper or that brochure that we have put together for people. When you're talking about, it's about strategies, right? So if you're worth, $25 million and you can live off of $500,000 a year, and you've got real estate and it's generating you $1 million a year, you can maintain your lifestyle pretty well, right?
Right.
So maybe you are about investing in strategies that you could get a ton of growth out of, right? Maybe you're like, I'm just going to put my money in the NASDAQ or ARK Invest or something like this and try to double, triple, quadruple my money, right?
Right.
Not usually, because usually those people have said, I already built my wealth. Now it's time to preserve my wealth. So usually those people don't do that, but you could, because as long as you have you've really got double the income you need. So you
Right.
could do different things. Now, if you have $1 million and you're trying to figure out how to retire, and you've come up with you need $50,000 or $60,000 a year to comfortably live off of, right?
Right.
That's a different story. You can't just say, oh, well, let me just throw this money in the casino and see what happens, right? You need to have a plan that will, number one, generate the income that you need, generate that $50,000 or $60,000 that you need to have that lifestyle that you want, but then also have it to protect you from these inflationary environments. So what are you
Yeah.
investing in? Are you investing in things that have um, pricing power increases, right? They have the power to increase their sales. They have the power to increase the income that they're bringing in, which will then increase the money that they can pay out to you as the owner of those companies, right?
Right. Right. So what I hear you saying is, to put it in the vernacular, so to speak, is that as inflation goes up, is your money invested in a way that's going to be able to stay up with inflation, to keep it very simply and to the point. Am I on the right track with that?
Yeah. Yeah. You want to invest in the companies that, number one, are paying you an income, but also that have pricing power. Okay.
All right.
Because if they raise their prices in
Mhm.
something and it's something that people just don't want anymore because it's too expensive, well, that didn't do any good for you, because now you're in a company that's failing and you didn't get the pricing power increase, right?
Yep.
Whereas, like, we'll just make up something like an electric utility. If prices go up, um, are you going to pay your electric bill?
Yeah. Sure
Yeah, I
am.
mean, if there's any possible way you can, because you're not gonna live without charging your iPhone, right? You're not gonna live without watching your TV.
Right, but that's the idea. So I think that when we come back, we should talk about ways that people will be able to keep up with, maybe to be able to get maybe a 4 or 5% dividend, and be able to still get price increase as well. If they invested $100,000, that it goes to 105, 110, or whatever the case may be. And we'll talk about that when we come back. We need to take a break right now. You listen to Financial Strategies with Andrew and Daniel Adjemi. We're giving away a book today that we think might help open up your minds to the possibilities that are available. It's by Jess Small, friend Jess Small, Turning Financial Planning Right Side Up. And we'd love to put this book in your hand. Jeff goes through, is a very easy read book, about 100, 150 pages, that will open up your mind to possibilities of different ways of investing than what you may already be inclined toward. So we'd love to put this in your hand. 800-725-7616. No charge. 800-725-7616. We'll be right back after this.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at adjemi.com. That's AGEMY.com. Welcome back to Financial Strategies with Andrew Adjemi in Connecticut and Daniel Adjemi in Colorado.
A couple of years ago, Roger offered his newly married daughter and her husband to sell them his house at a reduced rate. And Sally and her husband decided that they did not want to participate in it, did not want to take that opportunity, that door of opportunity that was being presented to them, because they were going to be moving to another part of the country within a few years. Well, over that period of time, Roger's house has increased in value about $75,000 to $100,000, and he has participated in that instead of Sally and her husband taking part in that, because of the opportunity that was presented and the possibilities that were there. I'm Andrew Adjemi.
And I'm Daniel Adjemi, and you're listening to Financial Strategies. Today, we're talking about opening doors of possibility and opening doors of possibility in your retirement. We want to help investors, especially people who are serious about their retirements, to be able to open up doors to possibilities in retirement so that they can maintain the lifestyle that they want to have, not just part way through and then have to go back to work, but they can maintain and hopefully even increase that lifestyle for their entire retirement. And this is so important today when markets are more volatile than they've ever been, when it's more difficult to get a decent income. And when there's more uncertainty today than there's been, for a couple of decades. And so our goal is to help people open up the doors of possibility so that they can be confident in their retirements.
Yes, exactly. And people don't know what they don't know. So we're trying to help bring to the table information that they can use that they may not get elsewhere, and Daniel, when we're talking about this, a lot of people think that the stock market is going up, but over the past few months it's gone up a little bit, then it's come down, and it's like you said, it's a lot of volatility. If you look back at a chart of the S&P 500 over the past 6 months, it's included a bunch of volatility in there, and the question is, what do retirees do about that? I mean, too many times I think people, during their working years, hey, they just love their paycheck and they're getting that paycheck and it's able to do all the things they want to do. And they buy the trucks or cars or boats or whatever it is they want to do. And then they think, okay, when I retire, I need $1 million because then I'm going to start taking out whatever, $50,000 a year, and it will be able to last me 20 years. But that's an old way of thinking. That's a way that is not as prevalent in the yesteryear. Yesteryear, people would live off of dividends and they wouldn't have to worry about the principal and spending down the principal. But some of the things we're talking about today about opening doors of possibility and opportunity for being able to make more people comfortable in retirement and confident that they'll be able to have a comfortable retirement. And we finished off the last segment talking about some different things that people can invest in, be able to get maybe 4 or 5% of interest and dividends and such, as well as being able to get some price and some growth on top of that as well. And I was, hoping that you'd be able to talk to us a little bit about that and some of those things that are out there that most people don't think about, like digital currency is one of those things, right? But you're a smart guy. Talk to us.
Well, it goes back to that story about Sally and the house. Why did the house go up in value?
Well, because COVID came and everybody wants to move out of the cities, and so it's driving up. There's this great supply, lesser supply, a great demand, and so it drives the price up.
But did it go up because of that, or did it go up because in the last 2 years, the government, the United States government and Federal Reserve have increased the money supply by 35%?
Both.
So you got to be careful when you talk about your earnings, right? We're talking about inflation. You have to be careful when you talk about how much money you made because of what you're denominating it.
Yeah.
So if the market went up X, right, but stamps, I mean, look at how much stamps have gone up. In 1971, right, they were 8 cents. So, right, or a gallon of gasoline was 40 cents. So that's 10x.
Right.
So have your investments or your house increased 10x since 71? Maybe, maybe not, but it depends what you're denominating in, right? And that's where you have to be really, really careful, because it matters what you're denominating in, because you need to be able to purchase things. It's not just about, oh, I have $1 million. Well, if in the future $1 million buys you a Lexus, well, now $1 million doesn't sound like very much money,
right?
So that's why we're talking about. That's why you brought up the cryptocurrencies, okay? Because cryptocurrency, we could do a whole show on this, but especially Bitcoin, right, is considered to be a store of value. It's a scarce asset. So as we continue to print money, it's guaranteed to go up, at least in dollar terms, because there's less of it and
Right.
more dollars, right?
Right.
That's one way to look at it. Another one would be network effects. So why is Facebook or Amazon what they're worth? Because of the network effects. Why is the internet worth what it's worth? Because of the network effects. So if you get a billion people using Bitcoin or cryptocurrency, what does it become worth? If you get 2 billion people using it, and it's a worldwide thing, so that's not a difficult thought to imagine that 1 billion or 2 billion people around the world could use it. It's
definitely a possibility. Yeah.
It's actually the fastest technology that's ever been accepted. Okay. Wow. Prior to that, it was the cell phone, right? The internet and then cell phones. Right. And this is even faster than the movement to cell phones.
Wow.
So it's happening, right? So that's one thing. Now, should you go put all your money in that? No, I'm not suggesting anybody do that. But we're talking about when things change, when the situation changes, you have to change your approach.
That's right. That's right. 3 things in life are certain: death, taxes, and change. So, you need to change with the times. You need to change with what's going on. Change, when you go from working years to retirement years, things change. You have to change properly. You can't keep your investments in the same fashion in your retirement years, because that's not going to work. It's like putting, new wine in old wine skins. It's going to fall apart. It's not going to be as sturdy as it should be. Well, I think that, this is a great time to be able to talk about that piece that we have, to be able to give away for our listeners, to be able to talk about retirement income and right and wrong way to invest for retirement. And, we'd like to, and you and our listening audience, you're listening to Financial Strategies with Andrew and Daniel Adjemi. Today's topic is opening doors of possibility. And we'd like to give you this piece that goes along with it, because a lot of people don't understand true income in retirement programs. They think of a withdrawal method as income, but we're talking about true income. So this is called the right and wrong ways to invest for income, or retirement income. Ask for it by name. You can call 800-725-7616, 800-725-7616. We're glad to get that to you free of charge. So, call 800-725-7616. Today's topic: opening doors of possibility. Daniel, when you're talking about, have things gone up, the denomination of it, and that sort of thing. Very key point. I was thinking about when you said, a house in 1970, has it gone up, 10 times? Well, I'm thinking of a particular person that I love much that bought a house in 1973. And I know what they paid for that in 1973. And today, guess what? It's worth 10 times that. So the number has gone up, but it's worth the same it was then now as it was then
in purchasing power.
In purchasing power, right? And that's real estate. And people don't think in those terms. And that's very key, because my house is worth so much more. But if you're going to buy another house, guess what? It's not really worth so much. You're just moving over, right? And everybody needs a house to live in. So that's very key. So even though the stock market is going up, you're saying, or it has, right now it's on its way down for a little bit. Who knows how long it's on its way down for? But what have other things gone for? Cars, the cost of cars. Try to buy a truck today, right? You're going to spend easily $100,000 if you can even find a brand new truck. Right. And I was at an RV show this past weekend, and I overheard a salesman talking about how he's so glad what's happened to the pricing of trucks, because people going out trying to buy a new truck for a fifth wheel, and they say, I might as well buy a Class C or Class A RV instead of a fifth wheel, because I'll get the truck with the rig, and I won't have to spend as much money. So, this is the kind of thing. What is it denominated in? What do you actually have purchasing power? So, we're coming up, we got another minute or so left in this segment, but, I want to be able to give people some ideas of the possibility, Daniel, and how can we salt their oats for the next segment?
So we talked about, we very, 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 very briefly talked about cryptos, right? And how you can see the world changing and how network effects have made people very, very, very rich. Okay.
Right.
So for a portion with inflation doing what it's doing, and we're talking about, your house feel like you made 10x, but in purchasing power, maybe it's exactly the same. How you can do better than that, right? But
Right.
that's not something that you want. If you're retired, you want to put all your money in. Not even
Right.
close, right? That's just an inflation hedge. That's something that will help you grow part of your money exponentially if this continues to go the way it has, which by all means, the Federal Reserve is just creating more money in the Treasury than they ever have before. So that will benefit scarce assets like that,
Right.
houses,
Real estate.
Bitcoin,
Yeah.
things like that. And then
Yeah.
the pricing power things we're talking about, these are income producing assets, right? That have
Mhm.
pricing power. So we talked about stamps going up, gasoline going up, Harvard tuitions going up, right? Rents going up, these kinds of things going up tremendously. So how can you benefit and connect your income to things like that? So as those go up, you get leverage on those going up and your income can stay ahead of that.
Yeah.
Those are some of the things that we're talking about when we're talking about opening doors to possibilities, things that people may have never even considered that can give them that lifestyle that they want to have all the way through retirement.
Excellent. So when we come back, we'll talk about opening up and giving you options for ideas of things that can help you and strategies to help you to be able to live all the way through retirement, enjoy the retirement that you have. You've been listening to Financial Strategies. Andrew Daniel. We're going to take a break here. Today's topic is opening the doors of possibility, and we have a book that we'd like to give away to the next 5 callers at 800-725-7616, Turning Financial Planning Right Side Up by Jeffrey Small. And this is going to be this is an easy read book to be able to give you some concept of how to be able to open up your mind to other options that you may or may not know about. And Jeff does a great job. If you're an engineer, you'll really love this book, but he does a great job putting it in a form that people can understand and appreciate. And we have that for the next 5 callers at 800-725-7616, free of charge, 800-725-7616. We'll be right back after this.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to agemy.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Adjemi in Connecticut and Daniel Adjemi in Colorado.
Yeah, there's this phenomena that's been very, very popularized probably since the 2000s, but maybe really the last decade. It's everybody does it. It's called buy the dip, right? Buy the dip. And what does that mean? It means when markets go down, you throw money in at the markets and you get the same thing you were trying to purchase for cheaper. And then the Federal Reserve says we're going to do asset purchases, or passive investing comes into the markets, pushes them back up, and you make money. And people's brains have been trained by the dip, just buy these funds, right, that have a broad exposure to especially 5 stocks or 6 stocks. And over time, you will always make money. But what happens in reverse?
You lose it.
I'm Daniel Adjemi.
I'm Andrew Adjemi. You're listening to Financial Strategies with Andrew and Daniel Adjemi. Today's topic is opening doors of possibility. We're talking about how there's only a small percentage, 27% of workers feel confident that they're going to have a comfortable retirement, and we're trying to get that number up. Coming to you today with the aspect of those things that people don't know what people don't know. So we're trying to be able to educate them in a way to be able to help them to make smart decisions for their retirement. Daniel, another terminology for what you're talking about, buying the dip, is dollar cost averaging. And people may not be familiar. Well, they might be familiar with one concept or the other concept from that standpoint, right? And this just turns my mind toward the aspect of how important strategies are, because buying the dip, dollar cost averaging is a strategy. It's not a particular investment that they're investing in. It's how that they're investing. So you can use aggressive investments with dollar cost averaging when you're trying to grow your money, and it works really well for you, or buying the dip, and it works really well. But your point was that if you're still using those, that aggressive approach, and that what worked really well when you're growing your money can actually hurt you and come against you, and actually make that strategy can actually decrease the amount of money you have for retirement and deplete your money and cannibalize your money. Terrible place to be in.
Well, we're focusing on possibilities today. And so how can people turn that into a possibility, right? Buying the dip has worked for a lot of years. And why has that worked?
Because
what do you
of the
have
volatility.
to have? No, what do you have to buy the dip?
Income, money constantly going into the account.
You have to have money. You can't buy the dip if you don't have any money. And nobody's going to give you money when markets are falling apart, right? You can't get a loan when markets are falling apart. So you have to have money. So if you're not working, where are you going to get that money from? Right? So let's talk about some possibilities of that. But before we do, what about the reverse? If you're living off of your money, you just went from being able to buy the dip, now you're forced to sell the dip.
Right.
So if assets come down, even for a short time like March, what were they down? Like 4 or 5 months before they got back up.
Right. Not long.
You still have to pay your bills. You still have to do things, self-responsibilities. You don't want to stop having a good lifestyle. You don't want to stop living for 5 months because things are down. And that was the fastest recovery in history, right?
Right.
So what do? How do you protect yourself from selling dips, from cannibalizing your money? So with dollar cost averaging, like you said, you automatically, without thinking about it, have money going in and buying dips. And then you wake up 20 years later and you accumulated all this money, right? You forget about it. It just automatically happens. The same thing happens in reverse. You need money to either pay your RMDs or to live the lifestyle that you want to have. And so 20 years later, you wake up and those dips turned into selling dips, not buying dips, right?
Right.
And it works in the reverse. You wake up 20 years later and you've cannibalized money instead of increased the value of it exponentially.
Right. Right. So the possibility that to open people's mind to is that of using the income to be able to help you, to be able to move you forward, instead of keeping the old fashioned way of investing your money that can actually work against you and cannibalize your money. Am I on track?
So if you build, you start with your base of an income generation vehicle or vehicles, right? Something that pays you. It's not dependent on markets going up. It's not dependent on you trading in and out every day. It's not depending on you listening to Jim Cramer on what the best stock in the world to buy is and then sell it next Tuesday, right?
Right.
You sit there, you do the things you love to do. If that's scuba diving, if that's traveling, if that's buying RVs, right? You do the thing you love to do while your money works and pays you.
Right.
And then now you get to decide what to do with that income. Do you want to buy into volatile things that you could try to increase your wealth, like some of the cryptocurrencies? That's where we're talking about combining these strategies, because if those have big dips, you have extra money getting paid into your account. You can put it into that and increase the overall value. If you say, no, that sounds too risky for me, you can have it go into other income producing vehicles and organically grow your income. And what will that do? Well, we talked about with just the simple 3% interest rate, what would happen if you need $75,000 a year to live on right now, today, in 10 years, you're going to need $100,000 at that 3% inflation rate just to have the same purchasing power.
Right.
And you're going to need 135 in 20 years. And you're going to need $182,000 a year of income just to support that lifestyle that you have today in 30 years from now at only 3% inflation rate. So this is where that compounding starts working again for you. And that's why we're talking about the doors of possibility, because people don't think about it this way, where you can have your money. You stop working because you wanted to retire, and you have this income pouring, generating funds coming into your account. So you can use them, you can invest them, and you can compound your wealth that way, compared to what we just talked about, where you need income to live off of, and you're actually having to sell, or you need to pay your RMD. You're actually having to sell assets,
right,
and cannibalizing yourself.
Yeah. One of the things I think of when you're talking about all these things, I think about how women are transforming the financial services industry from the standpoint of that women. There's, they have the power of women, right? They have this ability, this uncanny ability to be able to make good financial decisions because they are looking over the long term rather than, they're not as inclined toward the, the here and now, the feel good now, the exciting stuff today. They're looking for the steady Eddie, the longer term approach. And, when I'm talking about that, I'm thinking about that commission report that we put together called The Power of Women, and how they're transforming the industry, and that they're women make 70% of major financial decisions. And there's just a lot of things. There's a role that women play. And when women think about how, they thought of a possibility years ago of how women could vote and women could do all these things and women could be equal, right? And with males. And, from that standpoint, look at where women have come. So there's been a tremendous thing that they've been open to the possibilities and opportunities for possibilities. And we'd like to give this piece to you away today to those listening. Today, you've been listening to Financial Strategies with Andrew Daniel Adjemi, Opening Doors of Possibility. And we have this white paper called The Power of Women, this commission report. We'd love to put in your hand if you're so inclined. 800-725-7616. We'll get that to you. And there's no obligation, and it's free. 800-725-7616, The Power of Women.
Yeah, there's some myth busters in there too. So, those husbands, especially out there who haven't been listening to their wives on the finances, should grab that and check that out. We've seen a lot of people who will come in, and the guy has all these losses, right? He's like, I want to make some money. Because I have all these losses I want to write the money off against, right? I've seen this so many times come in, and the woman's over there shaking her head, and she has her money and she don't have any losses. And she's going steady Eddie, doing kind of these things we're talking about. And she's like, she's beat him in returns, and he hasn't learned. He's still doing it the same way. Like, let me try to make 500x today, and then whatever. And she's just going steady Eddie. And that's where you wake up 20 years later and your money has compounded. And it's this a big pool of money compared to just trying to hop on, the hot stock that you probably already missed the major moves, right?
Right. So one of the things I'm hearing you saying, Daniel, is that, opening doors of possibility and the opportunities that people have is kind of a steady Eddie approach. Again, it's going back to the strategy more than it is the investment vehicle himself, because it's not the investments that matter as much as about how you use those investments. The steady Eddie approach, taking that income and a steady Eddie, increasing it, right? What I'm always talking about is the chicken and the eggs, and how if you invest in chickens, you get eggs. And then if you take those eggs, you don't need those eggs right now because you're not retired. Well, you buy more chickens with those eggs. When you buy more chickens, you get more eggs, and then you get more eggs. You buy more chickens. You get more eggs. You buy more chickens, and it's just is a compounding effect that takes place that over time can be very significant to people. And there's other ways of doing things than what typically people and 401k plans tout.
Yeah, I think part of the reason why only that 27% of people considering retirement have confidence that they'll be able to have a good lifestyle in retirement is because people haven't opened the door to possibility, the fact that your money can work and generate income for you better than for most people. You can work and generate income for yourself. It works harder for you. And so when you learn that secret that your money can work for you, you don't have to hope that markets go up, but your money actually is working for you when you're on the beach, when you're hanging out with the grandkids, you're going to ballet class, right? It's constantly pumping money in your account when you're sleeping, all those things. And that, I think, can really give people a lot of possibilities, and should excite people.
Right.
Because when you start shifting that mindset, it will allow you to have the confidence you need to be in the place you need for retirement.
Exactly. Shifting the mindset. Things change. We need to change them appropriately. That's great, Daniel. Well, I see that we're coming up. We're needing to take a break. And before we do, I'd like to offer to you and our listening audience, you're listening to Financial Strategies with Andrew and Daniel Adjemi. Today's topic is opening doors of possibility. We have a book today that Turning Financial Planning Right Side Up by our friend Jeffrey Small. And this is a great book that we have available to you. The next 5 callers at 800-725-7616. It's for free, no obligation. 800-725-7616 will help you open up your mind and open up the doors of possibility for you to be able to have a comfortable retirement. 800-725-7616. We'll be right back after this. I love our client, Jimmy. He is such a great guy. Yeah, he is really something else. He comes in and we'll review the situation. I say, Jimmy, look at this. You've got over $100,000 a year of income, of money that you can depend upon for your rest of your life, Jimmy. And you've got whatever 1.5 million or whatever, but you got $100,000 of income coming out. And he says, I do. Well, that's pretty good, right? And I said, yeah, that's fantastic, man. And that's not counting your Social Security and pension and our other stuff. So, you got more than enough money to, you won the game of life, financially speaking, as far as retirement goes. And this is something you can count on. And then he comes in 3 months later, we talk again. And he says, and he said, oh, Andrew, I don't know how am I going to retire? I said, Jimmy, look, you got over $100,000 of income a year that will come into you. I do. Because he's so involved with life that he forgets about what his portfolio is doing. But Jimmy, I love him so much because he's opened his doors to the possibility of change, and he changed his portfolio to be able to give him the money that he needs now and for the rest of his life. I'm Andrew Adjemi.
And I'm Daniel Adjemi, and you're listening to Financial Strategies. Today, we're talking about opening doors to possibility. In your retirement, learning how you can maintain that lifestyle that you want to have through good times, through bad times, through inflationary times. And we want to help people open up their minds to seeing there is a different way.
Yeah, it's really cool when you're looking at the different portfolios that we've been able to put together for people and diversify them, truly diversify them. Daniel, one of the things that happens so often is I come across people and I'm doing a financial physical for them, whatnot. And they have, ABC mutual fund. They have XYC mutual fund, right? GTO mutual fund, diversified something mutual fund. Right. And they have all these mutual funds and they think they're diversified and they're good to go. And I say, well, you have a certain amount of diversification, but unfortunately, you probably own the FANG stocks, right? Facebook, Amazon, Apple, Google, and those stocks. You probably own those in each one of those accounts. So are you really diversified at the end of the day? No. And then you own them in a mutual fund. You're not owning them. You'd be better off in owning those things, individually than you would having them in a mutual fund. They just make the whole mutual fund look good. That's why they're there. They're making the mutual fund look good, but it's not that the mutual fund is any good. It's that these stocks are good. But there are other things besides that. There's other stocks that work well for people, right? And can help people get to where they want to go. But people don't know what they don't know. And they don't know how to invest. And they just do the same things the same way. That's insanity, right? Doing the same things the same way, expecting different results. And they end up in a rut when they're doing their retirement planning and investments and income, and it's can be disastrous for people. That's why people don't feel confident.
Yeah. And it's difficult. It's difficult to be confident when you haven't done it before, right?
Yeah.
Because our brains have been trained to save, and nobody's ever taught people how to turn those savings into a lifestyle, right? Into
Right.
lifestyle chips. Because it's great if you have $1 million, but if you're scared if you spend your $1 million, you won't have any more money, then you
Right.
don't have any lifestyle chips.
Yeah.
And then does the $1 million actually do you any good?
Right. And that's the thing that people don't understand. They don't know what they don't know, because back in the, up until like the 1990 or so, you could have a bank account that paid 5%. So people would understand the idea of living off the interest, not living off the principal. But since that's been gone for 30 plus years, people have forgotten that concept. But that concept is still a valid concept. And it's open your mind to the possibility that that concept can and will work for you in retirement. And that's why it's so important to be able to be coached through retirement. And that's what we talked about last week, right? Finding a retirement coach. And that's why it's so important to be able to understand things that you don't know, to be able to look at things differently and make changes at retirement.
Yeah. So some of those things, we're some of those things that we're talking about, because it's great that people now know that there is another way. What are some of these kinds of things? Well, some of the things we really like some international, right? International good companies that have pricing power, that are all around the world. International stocks that pay good dividends. Why? In the 1970s, when inflation was off the hook, what was the best way to pay? Well, gold did fine, gold, whatever, but it didn't pay an income, right?
Right.
Long duration, right? We talk about long duration assets. People think about like bonds, but stocks like Apple, Amazon, Facebook, these are long duration assets. If rates rise, these come down,
Mm-hmm.
right?
Right.
So what did really well? Good dividend stocks with pricing powers did really, really well in the 1970s.
Right.
Why international? Well, because you get more diversification. Everything is dollar denominated. And the US is printing the most money out of anybody. So when you diversify to some of these other countries, you're giving yourself not only income, but you're diversifying your income into different denominations, right? And so therefore, if the thing stays the same, but the dollar's coming down, you actually went up in value.
Right.
Your income actually went up in value, but we expect them to go up in value too, right? And they're paying nice dividends. So that's one of them.
Yeah, and that's besides the things we're normally talking about, which are, preferred securities and business development corporations and individual bonds and a couple of different kinds of annuities. And there's a lot of different things, but we're talking about, other than that, we're talking about diversifying. We're not talking about putting money in, all the money in international. And you're talking about international individual
companies, companies that are making tons of money, right? And for some reason, people are not giving them the valuations that they have. So you buying these things for cheap. You're getting paid to wait for them to come back up in value.
Yeah.
And they're buying back because they have so much cash flow. They're paying out their dividends. The dividends are not going away, and they're buying back. So even if the markets don't catch on, they're buying it back. There's less share. That means there's more earnings for each person who owns those companies, or dividend increases. They'll do one or the other.
Right. And that's a lot of those, the things that we're talking about today, I think people are going to be hard pressed to find that at your name brand, shop, from a financial perspective, right? A boutique shop is what, is going to be more likely to be able to offer these kinds of things and these kinds of opportunities to people to be able to stay ahead of inflation, ahead of taxation, and be able to give them the income that they need for the rest of retirement. Well, this is good, Daniel. So individual positions, not mutual funds, right? Mutual funds have a time and a place, but in my mind, they're more limited than most people have. Most people think mutual funds are the greatest thing since sliced bread. I disagree 100% on that, but they have their place. What else, Daniel?
So we So those work really good for protecting people from inflation. Okay. I said dividend stocks have been one of the best things to protect people's wealth in the 1970s with high inflation. Then you also have the non-denominated dollars, right? So they're not dollars. So you have protection against the government's continue to debase currencies. That's true diversification. Okay, something that's not correlated with typical markets, right?
Right.
Then we look at things like business development companies, and you can diversify into a lot of different things. So this is looking at the backbone of America. Okay, the small companies that hopefully will turn into the biggest companies. So you have a professional, institutional team that's looking at things that you're not even able to buy right now. Okay.
Right.
So, like you as an investor, as a retail investor, are not able to go in and buy certain asset classes.
Right.
So that you have this institutional money manager who's going and looking at, and all they do all day is look at these companies, and they find companies. Some of the ones we've invested in have invested in Airbnb,
Yeah.
DocuSign, Pinterest, Palantir, Facebook, YouTube. Okay. These were companies that you weren't even able to invest in. And they invest in these companies and they get paid interest. And they have to pay out 90% of all the money that they make. So you're getting these huge dividends. Okay. And then if these companies, they're collecting the interest, but then if these companies turn into Facebook or YouTube or Palantir, right? Or Pinterest, they have stock equity positions as well.
Wow.
Okay. And
Cool.
so they have to sell those at some point in time. And then they get this huge inflow of cash. And do you know what they do with the cash?
Pay it out.
They pay it out to you as the owner.
Nice.
And so this isn't a huge, you don't want to put all your money. These can be volatile.
Right.
But what they do, the good ones have easily outperformed the S&P 500 over the last 10 years. Okay.
Nice.
But what they do is they have a lot of income coming into your account. So you can spend that, or you have the opportunity to take advantages of dips in different asset classes. Because true diversification means something's always doing well. And if something's always doing well, then that means maybe something's not doing so well, which gives you opportunity to purchase that at a lower price, right? That's buying the dip. That's what we talked about worked for people for so long.
Yeah, that's the whole thing behind diversification. And, you know, one of the other things, you know, we're running out of time real fast here, Daniel, but one of the other things that I like so much is the idea of where, you know, if I could have wrote a book 30 years ago and I'd be paying royalties on that book today, I'd be sitting kind of pretty, right? Yeah. And, you know, but I didn't. So I don't get those royalties, but I can buy into royalties, right?
Those are one of the best things. And those have proven to be the best inflation hedge because they have the best pricing power. Okay. We talked about how the most important thing, if you want to protect yourself from inflation, is to be part of a company that has pricing power. Right. They can increase prices, and royalty and streaming companies are the absolute best way to do that. Like you said, that's a perfect example. If you get 1% of all streams, what if somebody got 1%? Look at it this way. What if somebody paid for your education?
Right.
And they said, Andrew, all I want in return is 1% of your future earning power. Let me ask you this question. Would that person have made a good bet? Would they have multiplied your education costs if they got 1% of your income?
Many times. That's right.
That's what we're talking about when we're talking about, and people don't understand these things. And that's a wonderful way of diversification and a wonderful way of protecting purchasing power.
Well, that reminds me of that. You know, which would you rather have, $1 million today or a penny doubled every day for a month? And people that don't know, they'll say, well, I want $1 million. Well, but if you take the penny doubled, I think it's something like $7 or $8 million at the end of the 30-day period, right? And that's kind of along those same lines is what I'm getting from you. Well, I see that we're out of time today. You've been listening to Financial Strategies with Andrew Daniel-Ajmi. Today's topic's been opening doors of possibility. There's a lot of opportunity and possibility out there. You just need to know where to get it from. And we suggest that, check out our podcasts and the old radio shows at agemy.com, agemy.com, and see what we have to offer to educate you to be able to make smart decisions for your retirement. And we're glad to be able to come today. We're giving away a book. We're giving away a brochure called The Power of Women that you can have, as well as this book, Turning Financial Planning Right Side Up by Jeffrey Small. You can have both of those for free, no obligation. Calling 800-725-7616, 800-725-7616. Until next time, we wish you a stress-free retirement.